Today we have two excellent presenters who we are very lucky and privileged to have. One is Dr. Michael Baker. He is a senior extension associate with Cornell University. He brings over 30 years of experience to that role, working at the county, regional, and state level. And he has emphasized development and implementation of marketing programs for small farms typical of the Northeast with a focus on beef. For 15 years, he has directed and led the Cornell Value Discovery Program, a feedlot and carcass evaluation program of cattle consigned from different farms. He is an expert in small-scale beef production, and we would like to welcome him. He will be going second in our agenda today. Leading off our webinar will be Will Sawyer. He's the lead economist in the protein sector of the Knowledge Exchange Division of CoBank. He's an animal protein economist in their Knowledge Exchange Division, where his focus is on providing market and industry research for the beef, pork, poultry, and beef sectors. I would also like to briefly touch on our disclaimer that while we are presenting information in good faith, believed to be accurate as of today, it should not be relied on solely for investment purposes. With that, I will turn it over to Will and allow him to lead us off in his discussion about animal proteins nationally.
Good afternoon, I can say, to everyone on the East Coast. Good afternoon to everyone else dialing in. Appreciate the invitation to speak. Wonderful having Farm Credit East as one of our partners in the system. So much to talk about. I won't spend too much time giving overview or introductions, but one thing that we have learned in knowledge exchange across the farm credit system is just how important agriculture is, in a way that I think shows a lot of appreciation for the system and for farm credit and for agriculture. One thing that we hear so much in farming over the last 5 to 10 years especially is just how far consumers are from their food and from how their food is produced. I think one of the really important and positive takeaways I'll say for COVID-19 is I think many consumers have a new appreciation for the folks that produce their food. So I appreciate everyone's efforts who's dialed in, not just to learn about our views, but what they do for rural America and what they do for the country. But let me jump in and kind of talk about where where we see things going from here, and it's not an easy answer. We feel at this point, as we're approaching the mid-year point of 2020, that we have been on an emotional roller coaster in 2020. If you kind of think about where we are today versus the start of the year, we started 2020 in a really positive mindset because of some really important trade agreements. One of, and probably the most important, is the U.S.-China Phase 1 agreement that was signed by the president in mid-January. It showed not just huge purchases of grains, especially on the soybean side, but animal protein as well. It also included the elimination of some of the barriers, not all the barriers, but some of the barriers that kept beef and chicken from the United States being able to be exported into China. So, when we thought about U.S. protein, we thought about the U.S.-China agreement from a purchases standpoint and an eligibility standpoint to be a huge game changer for the year. By mid to late February, the story had really changed due to our fears that coronavirus in the Chinese market would really limit their purchases of U.S. agriculture, including animal protein, and that brought us to the other side of the roller coaster. And then by March, we were feeling much better because we saw that those trade volumes from China really hadn't declined in a major way, and in fact, they had remained quite strong. And meanwhile, the U.S. consumer was stockpiling food at a level we had never seen before. Don't worry, we'll see that in a couple slides in more detail, but that brought the roller coaster to the other side. And of course, the area in April that got the most attention, and rightly so, I think, is the shutdown of nearly 24 meat plants across beef and pork especially. We saw capacity utilization fall by over 40%, and it became an extremely long month of April. But by May, we went to the other side, and plants were reopening at a very strong pace. capacity utilization was improving, not necessarily all the way back to normal, but a heck of a lot closer than we thought we would be. And so we find ourselves here at a fork in the road. Do we see the back half of 2020 being on the right side of the roller coaster, or do we see more challenges? And I think the answer is that, we see opportunities and threats across the U.S. protein space. We're all in this period of recovery, whether we're talking about employment, whether we're talking about our business travel, which which most of us have a big part of our jobs and our daily lives. That's obviously become a very little, small part of our jobs today. But there's other areas, whether it's consumer spending and plant capacity, that very much exhibit the V-shaped recovery that we all hope the overall economy exhibits. But that's not necessarily the case across the board. We do see some areas of some challenge. So, for example, unemployment obviously is showing some improvement, but it's still a far cry from where we were just 4 or 5 months ago. Producer profitability, I might move that today into the W-shaped rebound category instead of U-shaped. But as you can see, there's a lot of different ways that we can kind of think about recovery. But in the end, we do see the environment for protein producers, processors, and consumers looking significantly better today than where it was just a couple of months ago. And that is a very good sign. The question is, how much better does it get, and how long can it stay in that very positive level, and for how long? We got to talk about some winners from COVID-19. Direct-to-consumer food sales, an absolute clear winner. May not be the end-all be-all come 2021 and 2022, but I think there's a huge number of U.S. consumers, especially in urban areas, that had direct-to-consumer food available to them, but they've tried it in a way than they haven't before. That, I think, is going to mean we have many more sticky consumers going forward. Processor profitability, of course, something that's getting a lot of attention. That has been a very positive sign. We'll look at that in a little bit more detail. The grocery stores, who would have thought that the grocery stores could move their supply chains as much as they have? They have done very well during this time, and government payments and benefits have set a record in any possible context. And so some significant checks have been written and probably will continue to be written as we go through the summer and the back half of 2020. But let's talk about the consumer first and foremost. I do think that's a good place for us to start, mostly because that's really where this disruption in the protein supply chain really started. If you think about early to mid-March, we were getting concerned about the spread of coronavirus. What is the risk of coronavirus? We have some answers to those questions, but not very many. But when we look at the month of March, we can see this huge shift of food spending out of restaurants and out of takeout and out of the normal away from home channels and into the grocery store. And I think we really need to appreciate how much grocery stores and the retail food channel moved incredibly quickly to be able to help fill the pantries and the refrigerators and freezers of the U.S. consumer. It was an unheard of shift in just a matter of a couple of weeks. And obviously, food has been a real priority since then, and it's obviously normalized to some degree. And so instead of us seeing retail sales growth of 60% like we saw in mid-March, it's slowed down into the mid to high teens as it's normalized. And the word of normalization, we see restaurant and food service traffic starting to normalize as well. No longer is it down 60 to 70% like it was around the end of March and early April. It's now down in the 25 to 30%. That's still way down, don't get me wrong, but again, an improvement. Do we call that a V-shaped recovery? May not be as much of the V as we would like it to be. But let's talk about protein, the topic of the day. One thing that we've talked about in our research and knowledge exchange at CoBank is the impact of these plant shutdowns and slowdowns, not only in the way of meat inflation, but meat supply. And we really, unfortunately, started to see that play out in the retail data. Instead of the meat case being the huge driver of retail food sales, as it has been during COVID-19, we've lost a lot of that volume, again, due to the plant slowdowns and shutdowns. And so that volume growth at retail is now only up about 2 to 3% instead of being up 35 to 40% during March and April, and in fact, the first couple weeks of May. We do start to see that, I think, improve as we go through the next couple weeks of June, but you can see what happens on the farm, of course, is going to impact the consumer. We can see it here, and I think some pretty clear detail, But the most important question to me as a kind of national protein economist, and I think this is an important question for protein globally, is who's cooking dinner and where are we going to get it from? It's of course been the question for parents across the country every evening. But when we think about COVID-19, we see some very important demographic factors that are driving consumer comfort and getting out of the house and buying food instead of making it at home. We of course see in the top category that all U.S. adults are getting more and more comfortable. Instead of it being 15 to 20% of adults being comfortable, we're much closer to 30%. So that's a very positive sign. But when you look at important demographic factors of gender and age, political affiliation, income, urban versus rural, all of these are important factors. But what's interesting to me, I'll skip over the political front and give you the opportunity to analyze that for yourself. But when you look at age as a factor, to me, that might be the most important as we think of the future of food service. Which of the channels and the concepts in restaurants are going to do well and which ones are going to struggle more? Because when you look at the Gen Z folks who are in their early to mid 20s versus boomers who are obviously their parents and grandparents, there's a huge shift in their comfort level. And so when I think about a boomer generation who have heard many times, probably on a daily basis, about the risk of COVID-19 in certain age groups, that's where I think the restaurant concepts that have historically fit into that boomer generation may have a difficult time as we think about not just the rest of this year, but in years to come. That's an important one. But on the other side, we do have some winners. I think the millennial and Gen Z generations, which will of course continue to expand their spending power, those concepts which are based on more ethnic food, more casual and more quick dining experiences, those are the concepts that will do well. But as I said in the previous slide, we're seeing improvement in food service. We still have a ways to go. This is something I think for us to watch importantly going forward. Let's move from the consumer now to the processor and look at protein supply. Very important for us to remember that despite losing 24 meat plants over the course of April, and now all of those have reopened over the last month and a half, we've actually still seen more meat produced in the U.S. market so far this year, as we're looking here through the first 5.5 months of the year, than we did the year before. And a lot of that is driven by the first quarter, where meat production, as you can see on the right-hand side of this chart, that was up 6, 7, 8% in the first quarter. Now, unfortunately, late April, early May was anything but growth. Beef and pork production was down over 30%. Chicken saw less of a disruption, but any way you slice it, we saw a historic contraction in meat supply. Where we are today with beef plants now operating above or right around 95% capacity utilization, pork right around 90%. This is all a really positive sign. I would say an amazing improvement from where we were a month and a half ago. I think a lot of this is driven by a few things. I think President Trump's placement of the meat industry under the Defense Production Act allowed a lot of plants that would have closed in May to stay open. It allowed a lot of plants that would have taken much longer to reopen to get back online and get back on more quickly. It's not a coincidence in my mind where you see the bottom of the V, of this V-shaped recovery in late April, was specifically at that time. So I think that's had a very positive impact. But I also think the investments that the meat processors have made in PPE, in social distancing, in putting barriers between workers, this has all been a huge benefit as well. And so as you can see, meat production in the last couple of weeks have actually been above prior year levels. It's been a huge improvement and a very positive sign. An interesting way that the beef and pork folks are dealing with their continued labor issues is by operating more Saturdays than they would have normally, especially on the pork side of things. If you look at the last couple of weeks, most beef and pork plants are operating at 60 to 70% of their average Friday capacity. And so usually when we think of a Saturday, it's significantly lower than that, especially on the pork side of things, where very few pork plants operate on Saturdays in the months of May and June. You can see here in the data, and that's an indication of the labor challenges that still exist. And so that capacity that would normally be able to be operated in a matter of 5 days is now having to be operated in the matter of 5.5 days, obviously with more and more plants operating on Saturday. What does this mean? That's a lot of wear and tear on your labor force. Most folks don't like working on Saturdays. I don't think that's anything unique to the meat sector. And so we do think about how long can this go for, and what incentives do you need to provide to the workforce to make sure you can keep this operating, as obviously there are still labor disruptions in the meat supply chain. A second example of this, I'll go back to the previous slide in a second here, is on ham prices. And I know this may be a little specific of an example, but I think it really shows the labor shortage in a very specific detail. Ham, obviously the largest cutout in the pork complex. When you think about ham prices, very driven by exports to the Mexican market, most recently the Chinese market, a lot of deboning, etc. Well, the lack of deboning capacity due to labor issues has meant that more and more hams are being sold whole, whether that's in the U.S. market or internationally, and fewer are being able to be deboned. As a result, the component prices, the individual meat cuts, inside, outside knuckle of the ham itself, those prices have skyrocketed while ham prices have remained incredibly low. And so the spread now indicates exactly what we were talking about in terms of labor issues. We may see capacity far closer to normal than we would have expected, but the labor issues remain. Something for us to watch, and I think you can see it clearly here in this data. Let me go back to this previous slide a little bit out of order, so apologies for that. When we look at meat supplies having rebounded, meat prices have come down incredibly quickly as well. It's kind of the opposite, the upside down V shape. But what's interesting to me, and I think for us going forward, is if you look at the cutout for beef and pork today versus where we were just at the start of COVID-19 and just at the start of the plant shutdowns, we've really ridden the wave all the way back down. And meat prices today are very similar to where they were just a few months ago. You see the beef cutout yesterday was at $217 a hundredweight, very similar to where we were just a couple of months ago. So where is that important? Well, when you think about unemployment in the U.S. market, when you think about consumer spending in the U.S. market, when you think about the availability of sit-down steakhouses in the U.S. market, all of these things make me concerned that going forward, we're going to see more and more pressure on the cutout, whether that's beef or pork going forward, and what kind of pressure does that put on processors and producers as we think about the rest of the next few months. And speaking of producers, moving one step closer to the farm, about as close as we can get here when we look at hog producers, is that you look at the weekly or daily kill on the meat side of things, and you kind of can miss the fact that it's been a tale of two cities. Unfortunately, to some degree, a haves and the have-nots. I think this is true on beef, but pork kind of provides us a little bit better data to see this more clearly, is that if you look at the plant shutdowns and the rebuilding of capacity in April and May, you can see that it was the independent hog producer that felt the vast majority of that stress and that pain. And don't get me wrong, the independent, the contract grower or producer in the pork sector definitely saw some disruptions as well, but it's the independent producer who had been processing or selling hogs at $1.5 million per week, fell down to about 750,000 by late April or early May. That's a pretty simple math, being cut by half. And so when we think about the buildup and the backup of hogs in the U.S. market, which today is probably right around 3 million hogs, even with the improvement in capacity, it's those independent producers that are feeling the vast majority of that stress, the vast majority of that pain. And speaking of pain and profit, we've seen an incredible shift in the leverage as plants have slowed down and shut down. This is obviously beef and pork, producer and processor. We can see that on the pork side of things, despite incredible exports in January and February, March, prior to COVID-19's impact on the U.S. market, producers of hogs and cattle for that part in that way as well saw relatively weak margins. I don't think on the pork side of things we would have thought that our trade could be as outstanding as it was in the first quarter, yet producer margins were going to be so weak. What's the reason for that? Is that pork supply was growing at least as fast as we could export it. And so the domestic market became more of a challenge. When we look at the mix of profitability between producer and processor here, you see a lot of similarities between beef and pork. You can see obviously beef packing margins climbing well above historic highs. You can see those margins coming down pretty significantly. Where do we go from here? Well, I think for good or bad, we're going to see margins normalize over the next few weeks and the next couple months. These margins are going to contract on the processing side. The question is, well, is it as processor capacity improves, can that lift the margins for the producer? What we're starting to see in the last couple of weeks, and this may be a trend or a signal of the summer as well, where we're seeing pressure on the producer side and seeing producer margins roll off as well. So when we think about the losses for the industry in April and May on the producer side, we still remain in the camp of 2020 as being one of, if not the most challenging years for profitability in the sector for beef and pork producers. That's something that I think is driven by the fact that we've lost so much food service demand. I think it's driven by the fact that we've lost so much beef and pork capacity for that time in April and May. And so as a result, when we look at the overall protein complex, you can see the wave, the roller coaster of profitability. May was a heck of a lot better than April, and thankfully so, because April was pretty darn painful. And you can see here that not just beef and pork are seeing their margins starting to come down, broilers are as well. And so, overall protein profitability, the outlook is for weaker margins this summer, and that's something that's especially concerning because, as we know, if you're not making money in the summer, it's going to be especially hard to make money in the fall and the winter. And so supply and rationalization of supply, I think, is going to be something that's a part of the outlook, and we can already see producers doing that. So when we look at the future supply indicators across the species, and some of these have more forward-looking implications than others, whether it's sow slaughter or placements in the feedlots or broiler chick placements, they're all indicating contraction in the meat sector. The folks over at FAPRI at University of Missouri have very obviously well-regarded and respected models. They're expecting that this year, or if not maybe even last year, to be the peak in U.S. protein production and consumption, at least for the next 3 to 5 years. And I think this is a byproduct of the fact that we've seen very tough times for producers, and that's something that doesn't seem to be solving itself today. So what are some takeaways before I pass the baton? There's a lot of takeaways consumer-wise, processor-wise, producer. For the consumer, I think as I started, my presentation talking about the appreciation that consumers have for where their food comes from, I think that's a very positive sign for us in agriculture, and for us trying to tell our story. Consumers going to have, a much closer appreciation, but also a much closer eye as to how we are producing our food. And I think of a level of shoring up the supply chains. I saw many articles where it was written that the supply chain for food was broken. I think that's a little bit melodramatic, but I do think that processors are going to be asked to provide more surety of supply and more surety of their ability to operate going forward. And so that's where we hear this question time and time again, an increase in smaller processors, more local processors as a somewhat of an insurance policy. I think that's an interesting idea. It may work in some places better than others, I'll say. In addition to that, I think processors are going to be asked to make significant capital investments in automation and mechanization. You know, the weakest link in the supply chain so far over the last few months has been the worker, right? We are the ones that can get sick, machines not so much. And so the ability to add robotic technology, to add in automation, mechanization, all of these investments, which are none too cheap, are going to be somewhat of a requirement across beef, pork, and chicken, I think, in the years to come. On the producer side, you know, I think the lack of vertical integration in some supply chains has made the last few months especially difficult. I think vertical integration, whether that comes through attrition of producers or through acquisition activity, I think there's a lot, or maybe even more strict or more tight relationships between producers and processors. All of these, in my mind, are going to add more vertical integration into the market. And so that's, I think, going to happen at the producer level, especially over the next, I think over the next few years. It's not going to play out just this summer, but many of these are going to have long implications. And that's one of the major takeaways, I think, going forward, is how do we, you know, what do we think about as the kind of long-term implications? And that's where I think the scars of COVID-19 on the producer especially, but also on the consumer, means that we're going to see a lot of change over the next few years, something we'll definitely follow and write about in our research. But I appreciate everybody's attention, and I will pass the baton. Thanks so much, everybody.
So I'm going to review some of the things that Will talked about relative to the Northeast market and how it affected us specifically. So first will be just a quick overview of what happened here in terms of the packers. Then we'll look at what effect that had on our local prices here in New York. Then we'll look at some research that we've done examining our small processors in New York and the Northeast. And then finally, another project looking at what we might have the capability to do in New York relative to our biological resources. Just a quick overview. As Will mentioned, the crisis created a stockpiling of ground beef early on. And what that prompted Cargill to do down in Wyalusing, Pennsylvania, is to suspend the slaughter of finished cattle. So their purchase then was all cull cows. Shortly after that, JBS temporarily closed due to COVID, and they are a major purchaser of our finished beef here in the Northeast. So at that time, that ended up being that there was no market for finished cattle. Nicholas Meats, which is a mid-size plant, also were only buying what they could process in a few days. They didn't want to get caught with extra inventory. Also, Cargill reduced their slaughter capacity to add insult to injury because, again, of worker concerns and worker safety. And consumer purchasing habits have changed, as Will mentioned out. We're headed hopefully back more to service purchases, but that's still going to be down compared to retail purchases. These are some of the things that are happening and will continue to slow the rate of increase, although with the last numbers I saw that, at least on the beef side, we're almost to 95+% capacity compared to last year. So, which is an increase that nobody expected to happen so quickly. That being said, this is, scanning of employees as they come in, regular temperature checks throughout the day, testing, barriers, all of these things are slowing capacity and will continue to have an effect. So the pricing data I want to share with you is made available by a grant from New York State Ag and Markets, and I use some of that money to hire livestock reporters. And so we cover six sale barns throughout the state with the idea of providing transparency in the price of cattle with a uniform description of the cattle. Many of these markets have their own websites, but not a lot of description. So it's kind of hard to compare apples to oranges. And my mapping skills are not very good, but this is Cherry Creek Empire Facility, and this is Finger Lakes Livestock up in Canandaigua, and you can see where the rest of them are. So by compiling this data weekly, I can see the effect that it had on our market. And so if we look at cold cow prices, back in the first part of the year, we were in that $55 range. This period right in here from the end of March through essentially the end of May the beginning of May through the end of May or April resulted in prices really taking a hit, in part because there wasn't many buyers in the market. JBS wasn't buying anything. Cargill had reduced their purchasing, and Nicholas was also buying fewer animals. So that was reflected in the price. The good news is that since the low, the end of March, 1st of April, prices have rebounded almost $17 a hundred. And so we are higher than we were in January. Now, part of this is seasonal. Cold cow prices do increase generally through the summer and then begin to decline again, but it's much more so an indication of a much greater buyer availability. What happened to our finished cattle prices? The big note to look here is that we've seen some decline, and Will mentioned that prices have declined in the recent week, and that's likely to continue. But again, that's a seasonal effect. We do expect finished cattle prices to peak sometime the end of March and through May, and then they decline through the summer before they pick back up in the fall. But this illustrates here that the challenge that the finished producer had. You can see here on 326, there's no data until essentially 5/7. So there was no market, no purchasing of finished cattle during that time frame in New York, at least in the sales that we report. So it was a pretty tough time for producers to have to hold on to those cattle, which the finished cattle are very expensive at that part of their stage of growth. They're fat, and to meet their energy requirements is excessively demanding. What about our feeder calf prices? Now, feeder calf prices are a little bit more of a shining spot, if you will. Our feeder calf prices have shown a great increase since February. In fact, starting in April, our prices have been equal to, or in the last report in June, higher than last year's. And so that's been a bright spot for those selling feeder cattle. So what will feeder prices be this fall? That's a magical question, but here's some indicators. Feed's going to be cheap, whether it be corn or distillers grains, and so that will allow feeders, cattle feeders, to purchase cattle at a lower break even because their feed costs will be lower. When we look at the live cattle futures in analysis, analysts that I've been keeping track of indicate that in the fourth quarter, feed yards hopefully will be at least in a break-even position, which is encouraging them, for purchase of feeder calves this fall. CattleFax predicts that calves will be at last year's levels, which in New York last year in October through December, that puts us at $1.20, $1.30 a hundredweight, which aren't terribly high prices, but as an extension specialist, I'd be remiss to not show this next slide. Well, I'll just show you this one first. As a cattle feature, the feeder cattle futures have shown a pretty good increase since the COVID crisis in April. And so that's gone up $23 a hundred. Now it's kind of leveled off in the last few weeks, but at least the November feeder cattle futures are looking positive and going in the right direction. So I said our price ought to be in that $1.20 range, but I just wanted to show you a sale last year. It was in December, and there was cattle that came in with what we call value added. We had a strict set of preconditioning, vaccination, and weaning protocols. That came from reputation herds, somebody that or people knew about these cattle and how well they performed. And we compared them to cattle that came in basically nondescript or might have had some vaccines, but not a very complex protocol. And you look at the difference per head in those cattle weighing about the same, a difference of $132 a head. So while we're predicting, it's being predicted $1.20, $1.30 this fall, those prices could be quite a bit higher with some management on the producer end of this. So moving now into the local processing industry, local pack, this time of the year, we're typically pretty easy to get into a packing of local processor. It's a slow time for them, but because of the consumers interested in one, securing a supply, as well as maybe wanting to buy protein that they feel is safer, local packers are just jammed tight. Many of them are scheduling into 2021. So this was a study we just completed last year in March, where we did a survey of packers, USDA packing houses in New York up through Maine. Asked a whole bunch of questions, but there's a couple of things I wanted to pull out. Mackenzie Worrell was the one that did the survey, and she was able to get into 80% of the plants. Any of you that have worked with small processors know that they're busy, not always interested in some of these surveys, but her tenacity was able to get in and get some really good data. And what I wanted to show you here is that typically, now this is pre-COVID, if you look out here into August and September, the days to schedule a beef, now this is beef, are in this purple range, most of them purple and blue, which is 90 to 120 days, and you've even got 150 days or 5 months before you can schedule. Versus out here in January through July, you're looking at 7 to 14, maybe a month in some cases to schedule. And so seasonality is a really big issue for our packers. And will this change with COVID once we get into more normal conditions? That's a great question. We don't know. We suspect it might, but we need to be aware of the seasonality issue. The other factor, and these were the key findings about labor, cold storage, funding, and the seasonality. But one of the things that we think about is how can we help packers expand to be able to receive more cattle. And this was the limits to cold storage. In other words, 68% stated that if they had more cooler and processing space, they could slaughter more cattle. And that's what the survey found, is that they can only process half of the number of cattle that they slaughter. So the issue really currently is not more capacity to slaughter cattle, but to help our smaller packers build on this cooler and storage space issue. And there may be ways to do that through low interest loans, grants, and so on. But building a new plant isn't necessarily where we need to go. So with the interest in buying direct from the farm, I had Matt LaRue, who's a marketing specialist, present a webinar on how to help producers if they're going into this bulk meat business. And he laid out things in two different ways. One was the new local meat buyer. He called the COVID crisis consumers. So they're the ones that weren't necessarily buying locally, but now all of a sudden they wanted to. And there's several reasons for that. They want to leave home as little as possible, still going on. They prefer online ordering and payment. Again, they want as little interaction as possible. They want it convenient. They're worried about food shortages, especially meat. That's going to change as production gets back in to the stores. And in fact, just anecdotally, the grocery stores I've been in, product has not been an issue. They're worried about bringing the virus into the home on goods. That hasn't been substantiated, but that still is a concern. They may not have money for large purchases, and they're also nervous about spending on large purchases. They don't know where their job situation is. Some of them are out of work now, and so that is a concern for them. Characteristics of the new local buyer are they're cooking more or most of their meals at home. That's starting to change, but that still is a great increase. In fact, when we look, there was a study that came out of China and some other Asian countries that surveyed the consumer there, and they indicated that regardless of what happens and things go back to normal, because they have gotten used to cooking at home, they plan to continue to do more of that. And you've seen that in articles, you know, an increase in family time and all the things that go nicely with eating together. They're willing to buy in bulk, stockpile, if you will. They see the value in that. They're eager to buy from a short supply chain. So instead of having 600 workers on a processing floor in a big plant, you might have 5 to 10 in some of these smaller plants. They want to support local business. They're looking for ideas for meals. This is especially true of the millennials and the Gen X generation. My kids are examples of that. And they understand that bulk pricing offers a better value than buying single cuts. So while dollars spent is higher, when you break it down into what it's costing you to buy a steak, it's a fair amount cheaper. And this was an interesting quote that pulled from ProAgra, and she said that this whole idea of social distancing impacting our processors, people are becoming more efficient and go online more, and that's been happening greatly on other goods, not as much with meat, but that's happening and will continue to happen. And so these trends really shouldn't scare off producers because they need to adapt to that. And that's going to be the way to the future, regardless of what this current situation is. And then finally, I want to just review very quickly a research project where we looked at the biological capacity is, can we expand ruminant production in the Northeast? What would it take? How much forage would it take? How much land would it take? And do we have processing local processing to deal with that? And this was focused entirely on grass finishing. We do have significant capacity to expand grass finished beef production. It's estimated there's anywhere between 2 and 3 million acres in New York that are currently idle and not being used. Most of it formally ag ground. But there's some uncertainties. This land is there, but is it available? We know that for purchase or leasing, the owners may not be interested in doing that for a variety of reasons. Barge productivity, one of the things we looked at was the current productivity and what it could be by implementing improved grazing management, improved fertility, and so on. And our estimates is that we could closely double the productivity of our pasture lands by proper management. Cost of winter feed is a tough one. We live in a pretty miserable area for winter feeding. Last winter was probably the best example when the ground really never froze, except if you're up in northern New York. And so cow-calf producers dealt with mud all winter long. That increases energy costs, that increases wear and tear on the animals for having to deal with mud, and putting in buildings is very expensive, and so it doesn't make sense. So that's something we're really going to have to focus on. Then we looked at the slaughter and processing. What would happen if, in fact, we took all of the calves that are currently produced by our cow herd in this region and finish them on grass? Would we have the capacity to do that, and when would we start to hit some bottlenecks? And what we found is that by looking at where the land is that's available for grazing or potentially available for grazing, and where a processor is, 80% of the production, all of the production is within 80 miles of a processor. Now, there's issues, we know that. Processors may not do the extra value stuff, such as smoking and beef sticks and so on. And there's also disagreements between the land or the cattle owner and the processor in terms of working together. So we know those are some issues, but the reality is the lands for potential grazing are near a packer. Now, if we try to double the volume, that's when we get into trouble, and that's when we'd have to add more plants. But based on our research, if we take these existing plants and increase their capacity to process and their cooler capacity, so that slaughter equal processing numbers, then we do have the capacity to do that. And then finally, as Will mentioned, in terms of working together, integration, we're a small area relative to herd size, and so it's going to take some concerted effort to aggregate these cattle so that we can make these processors as efficient as they need to be, as well as the markets. Not all markets will take a whole animal. And so we need to have enough cattle that we can ship parts of the animal one direction and parts of the animal the other direction based on market requirements. We've got to address year-round production. We looked at spring and fall calving. We modeled that and found that, in fact, that can be done. Again, from a biological resource standpoint, there's a little bit more cost in the fall calving system because of higher cost of feed for a lactating cow. But if we're going to meet the demands of these markets, we have to be able to provide these year-round. And we're going to have to invest in existing infrastructure. As I mentioned, adding processing and cooler space to the existing packing houses that we have in this area. So with that, I'll conclude my presentation. You'll get this slide so you can go to these markets or these pages where we report New York markets and get additional information. So with that, I'll turn it back to Chris, I guess.
Yeah, thank you very much, Dr. Baker. Question, I guess, for both of you. When the meat market hit a low point in April, and by that I think we're referring to the plant shutdowns and that kind of thing, the capacity hit a low point. There was discussion about meat animals being euthanized due to the lack of purchasing by slaughter facilities. And I'm sure that this varies by species and by location. But in hindsight, did euthanization really occur as badly as was expected? And do you think it's still an issue? Will, do you want to take your first crack at that?
Yeah, thanks for the opportunity to try to address a really tough question. The reason why it's so difficult, I mean, we can see capacity, we can see how many animals we expected to come to market. So, in my mind, this is really a pork story for the most part. Did happen some on the poultry side, but not in a hugely material way. So, from a pork perspective, yes, of course, we did see some euthanization going on. To what degree? That's really the $1 million question at this point, because as I said, I think in my presentation, we kind of see somewhere around 3 million hogs that we would have expected to come to market are under processed. Have they found new homes in the supply chain? Have folks reopened barns that were closed? Have they been able to stretch their supply chain by putting hogs on a maintenance diet? There's a lot of different things, and obviously the last and worst result is euthanasia. The data point that we are following that's starting to give us a sense that possibly euthanasia was a pretty significant component of what's happened to those under-processed hogs that we put around 3 million, is that now hog weights are starting to come down. So that's starting to show a level of currentness that would possibly indicate, not for sure, that this real backup in heavyweight hogs isn't there in the degree that would have been indicated if they had not been euthanized. So those are the tea leaves, as you can tell, we're putting together. It doesn't give us a for sure answer, but there are some indications to show that there was significant euthanasia in the pork industry.
So does NASS directly track that at all?
Not that I know of, no.
Okay, so we have to sort of infer the numbers.
That's right.
Okay.
That's right.
Dr. Baker, you have any thoughts about the regional market here in the Northeast?
Relative to the euthanasia, I am not aware of any cattle that were euthanized. The advantage that a ruminant animal has over these simple stomached animals, hogs and poultry, is that you can put them on a diet that slows the rate of growth. Hogs are so programmed that dropping them to a lower plane of nutrition just doesn't work well at all. And so that's what's happened across the country, was to slow these cattle up a little bit so that there would be time to get them in the marketplace. Now, interesting, what has happened is because these cattle are on feed longer, carcass weights are, correct me if I'm wrong here, Will, but I think beef carcass weights are still going up. And the number of cattle in that choice and prime quality grade has increased about 2 percentage points. So the flip side of that is they're also fatter. They're in that what we call yield grade 3s and 4s. 3s and 4s take more time to process, which slows down the processing chain speed or processing speed of these plants. So, but to answer your question, in New York or in the Northeast, I'm not aware of any of that.
Okay. A question for both of you is, if we put dairy cow sales aside, how much intersection or interplay between the national markets that you discussed, Will, and the regional markets that Dr. Baker discussed, how closely connected do you think those are, or are they really almost separate markets?
That's a good question. I'd have to think. Maybe I'll let Dr. Baker start, and if maybe I'll follow on
Sure.
there.
Well, what had happened there for a while was because of the demand for ground beef, a lot of the products, meat cuts that would come out of finished beef were being turned into ground beef to meet that demand. So that in part what was going on. Now, I looked at some numbers the other day, and that's changing. Some of those round and quad cuts are coming down in value off the finished cattle. So that indicates a decrease in demand overall, but also a decrease in demand or increased availability, if you will, of ground beef. Pricing will obviously be affected by supply, but I don't think the seasonal patterns should be discounted as well.
Okay. Will, do you have any thoughts to add on that, or?
No, I think that sounds very consistent with the national story. I think ground beef has been the ground product, has been the product to go to, whether that's ground beef or turkey for that matter. And I think, so I agree with Dr. Baker there.
Okay. So Dr. Baker, you talked a fair amount about slaughter capacity. So kind of in a bottom line sense, do you feel that there's adequate slaughter capacity in the region, and it's really more of a seasonal constraint issue?
Well, that's what our study concluded in 2019. That has changed drastically right now. The question becomes, and part of Matt's presentation, which I didn't go into, was looking at post-COVID and this post-COVID crisis buyer. How do we keep them in the local market? So right now, as I mentioned, these small packers are just full to the gills. But as meat becomes more available and at cheaper prices at the retail level, will consumers still want to buy locally? And of course, those that sell direct are hoping to maintain those. And if farmers will change their management system to provide cattle in the off-time slow seasons, and packers do some incentivizing, maybe a lower price during those slow times, I think that can even out that level of demand year round. But that's, whether that'll happen remains to be seen. And labor. So if they can, again, so they're in the slow season, some of them actually let labor go in the slow season. So if they could maintain a labor force year round by having year round supply, that would be beneficial to the small packer.
Sure. Will, the shutdown at meat packing plants created a lot of problems. We had high prices at retail or higher prices at retail, perhaps some shortages of some things. Meanwhile, the producers were faced with lower buy volumes and lower prices, and even perhaps in the case of pork, some euthanizing. So it was like a lose-lose on both sides of it.
Right.
Do you think that situation has largely resolved? Are we out of the woods, or is that still a concern?
Well, we have seen very few plants, or at least publicly announced plant shutdowns or slowdowns since in the last month. Tyson had a facility that closed, but very tellingly, it did not close for weeks like what we saw in April. It closed for a few days. So to answer your question, yes, I still think there's the risk of plant shutdowns and slowdowns. And I don't, I'm obviously not going to be the first one to talk about, possible increase in COVID cases. But if you think about that ham exhibit I showed, it showed that there's still labor constraints in a significant way. So while capacity may be close to normal, our ability to process in a normal way is far from it. What does that mean? That means that we're relying on fewer employees to do the same amount of work. And so each one of those folks, if to lose them is more material, of course. So I do think there is that risk. We still see challenging margins. I think in the industry, while food service is, much better, of course, than it was a few months ago, but still being down 25 to 30% for a very important sector like full service restaurants and others is going to make it a challenge for producers.
Okay. Sorry, go ahead, Dr. Baker.
I was going to say, well, aren't the predictions that it'll be at least until October with cattle, where this backlog will be cleaned up? Because you got to remember, there's a lot of cattle in the normal supply chain that they have to deal with, not to mention all these extras.
Absolutely.
Great. So we're at the top of the hour. I want to be respectful of everyone's time, but I'll throw one more at you, Dr. Baker. For the animal protein sector, particularly beef in the Northeast, how much of it do you feel is the sort of niche or value added sales versus sales that are sort of more commodity oriented? If you had to take a guess as to sort of the split there, what would you estimate those at?
So I'm going to look at the grain finished sector, because while there's growing interest in some growing supply of grass finish, we still finish more cattle on grain, albeit a small number compared to big states. A number of our feed yards are in that niche market, such as natural. And so I'm going to say probably 30% are in that range. And the remainder are commodity producers just selling either through the auction barn or direct to the packer. So, and that may increase over time because in the Northeast, cattle feeders struggle with cost of production. Our grain prices tend to be a little bit higher. We're feeding in smaller numbers, so economies of scale can't be reached as efficiently as much larger feed yards. So going to these natural markets has been a help for those that have been able to develop a management system to fit that. And we've got the consumer demand for that. So I think that'll increase, but my swag, if you will, is probably 30-70 natural to commodity.
Okay. So with that, we'll wrap it up. A couple of things before we close off. The Farm Credit East webinar series is available, past, present, and future webinars at farmcrediteast.com/webinars. That's where the recording and the slides of today's webinar will be posted, as well as our future webinars. We do have one coming up on the fruit and vegetable outlook, an early season look, and so that's available to our customers as well as non-customers. I would also like to put in a plug for our COVID-19 Resource Hub. That's available on our homepage under the Knowledge Exchange tab. There's a lot of information coming out all the time regarding the various relief programs, restrictions, tips, that sort of thing. That is updated literally probably every single day with new information. And so I would encourage you to check that out. With that, I will thank our presenters, Dr. Michael Baker and Will Sawyer. And with that, we're adjourned. Thank you very much, everyone.
Thank you all.